This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Now let's get to the chart deck. Listeners, you'll find the download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over David Rosenberg's picture that says looking for the downloads. All right, let's get to these charts now. Nick, let's start on page 2. We have S&P 500, and I know you were looking at some of the implied ranges. Obviously, a bit of a breakout here with it going above its 200-day moving average. What are the levels you're watching?
Yeah, Patrick, looking at the December 16th monthly OPEX on SPX, we have an implied move of about 150 points with upside projected to be about 42.30 with a gap fill at 41.10 and heavy resistance at 41.20. Now, the downside projected is at 39.30 with support at 38.50 or so. Now, looking at the chart here, we can see that there could be upside as high as 42.50 or so. And given that we're in December right now and volume tends to dry up a little bit, it's possible we see a run into the end of the year here, which a lot of the bulls have been hoping for. Eric, what are your thoughts here?
As Rosie said in the feature interview, most bear market rallies have failed at or near the 200-day moving average. We moved above it Wednesday and fairly decisively, but only just above it so far. So to my thinking, this is make or break time for the S&P. If this turns out to be a fake break and we close below the 200-day moving average and stay there for a few days, that would say to me the top is in for this bear market rally and probably all downhill from here. But if this rally continues higher, I think it's probably a sign that a Santa Claus rally will continue through year end. So the jury's still out on my mind as to what's happening in the short term. But if this market's going to roll over to the downside, it needs to do that pretty darn soon. But here's what I want to ask you guys as the option gurus in the house. I really don't know what comes next in the short term for equities, but I strongly agree with Rosie that the overall bear market isn't over yet. I'm not inclined to make any huge downside speculative bets because, frankly, I'm not an equity trader per se. But I do have plenty of long-term buy-and-hold equity positions in gold miners, uranium miners, advanced nuclear technologies, and non-crypto decentralized finance. Since this might be a top or near a top of a bear market rally, I'm inclined to start laying on some S&P puts as a hedge against the broader market selling off in 2023 or maybe even sooner as the bigger picture bear market continues. My problem is that long-dated at-the-money puts on S&P futures expiring at the end of 2023 are not exactly cheap at current implied vol levels, and I have a fairly big chunk of notional principal to hedge across all of my long buy-and-hold equity positions. So what are your thoughts on more creative hedging strategies to avoid paying through the nose for long-dated S&P futures puts at these prices? Again, my goal is just to hedge the downside risk if the whole market crashes in 2023 and takes my gold and uranium mining shares and advanced nuclear and DeFi shares with it.
Yeah, Eric, that hedging topic is really an interesting one I want to dive into. But first, I wanted to just make a quick comment on the S&P. Obviously, we've been looking for this bounce to continue, and we're starting to approach levels that I at least am starting to be suspect of. The really big question for me is it as simple as everyone is thinking, which is that, we have a Christmas rally and then a bear market resumes next year. The market tends to throw curveballs and surprises. And, it's I always try to ask the question, how is the market going to catch everyone off guard? And so to me, that increases the risk that either A, the market actually has a surprising upside surge that catches all the participants off guard, or quite the opposite, the sell-off, begins in earnest and catches everyone that's been waiting for an opportunity to short later in the December off guard. And I certainly am not predicting necessarily one of those, but the fact that it seems increasingly consensus the way that this kind of Christmas rally was going to be play out. Anyway, but your topic on hedging is a really important one, and obviously, Nick and I spend a lot of time thinking about option strategies and how to implement hedges in a portfolio. Obviously, staying long this market here, at least on the short term, makes sense, but having some way to protect your portfolio is important. Now, when the question is, I want protection, I want to hedge, that's a pretty open-ended question. The question is, how long do you want your hedge to be? And more importantly, what are you trying to hedge? Do you want to remove all left tail risk on a market decline where you need the hedge to build huge delta dollars and remove all downside risk? Or are you simply trying to blunt the damage that a 20% decline in the stock market would do to your portfolio? And those are important questions to ask, because the construction of a hedge is very much dependent on what you're trying to hedge. Now, with that said, I would personally be taking a look at this from a perspective of using a debit spread hedge. The view here is that if the stock market was to turn down, a 20 to 25% decline down towards the 3,200 to 3,000 level would be realistic downside target if there was going to be another leg of a bear. And therefore, one of the interesting considerations that I was put on is that, well, why not then potentially put on just a pure put debit spread on the SPX? And an example of that, if you just go to the first quarter of the year out to the March expiration on the SPX options, doing a 500 S&P point wide debit spread between, let's say, 3,700 down to 3,200 can be open just under $50. So, if that came in a big way, you almost have a 10 to 1 payoff on it, and it doesn't cost you a huge carry to have this put protection on. This would massively blunt the damage done on a bear leg if you did have a series of long holdings. And so that's one of the ways that I would approach it. But Nick, I know you take a much more active approach to managing these kinds of hedges. What kind of a hedge would you construct for a first quarter risk?
Yeah, it's a great question to ask. And again, I always like to ask the question, as you said, what is the timing of your thesis, as well as what is the magnitude you expect on the downside, perhaps, for a hedge? There are many ways to trade this, right? You could use SPY or SPX, SPX being the better one, I would say, in my opinion, because it's cash settled. You could use variations of ratio spreads or butterflies. But to keep it more simple here, I would say the best way that I see to hedge would be to look at your portfolio, analyze what you're holding, and determine how much pain you'd suffer on a downside correction of, say, like 10%, 20%, and then from there, build out your strategy. I prefer to go with about 60 days out, so somewhere around January timeframe versus the March, as Patrick suggested. What I would look at perhaps is downside to the lows of 3,500, possibly below that to 3,200, as Patrick said as well. And I would also go with put spreads using SPX. So looking at the option chain, if, for example, you wanted to do something like this, you could go with January 20th OPEX, the $3,500 puts long down to $3,200 on the puts short. Right there, the net cost of that trade would be only about $580 per position. So your upside there would be about $29,500 for $500 risk, roughly, on that position, right? So you're risking basically $500 or so with upside of almost $30,000. And again, this is a hedge. It's not meant to be a payout where you're trying to make a profit on this trade, right? You're hedging your portfolio in aggregate using a hedge.
What makes that interesting, to cut you off here, Nick, is this idea that you could when you're doing such a low cost left tail kind of hedge, you can always throw a call credit spread on the markets up above and use the proceeds to net that cost down to almost zero. Is that something that you commonly do?
Absolutely, yeah. I was going to actually add that too. So awesome minds, right? But looking at way above right now on SPX for January 20th OPEX again. So for example, as Patrick, as you just said, if we were to sell the $4,500, for example, call option on SPX, and say we were to buy, for example, the 45.50, which is a 50 wide credit spread on SPX. You're getting a credit of about $3 right there almost. So you're reducing your debit on the put side from about $5.80 down to about roughly $3 or so. So you're reducing your overall cost on the hedge a little bit more. And again, the whole idea here is that if we push to the upside of 4,500, well, that's an upside of an additional 10% from here. Which means your portfolio should see gains as well. So you're not too concerned about that move to the upside. And remember that SPX is cash settled, so you're not worried about assignment risk whatsoever. So that's how I would play it probably is, again, as we said, a put spread out of the money on the downside and financing that with a credit call spread way out of the money again on the upside for the January OPEX. That's how I would play it.
Yeah, what I think we should do, Nick, is maybe in next week's episode, we can elaborate on the idea of using something like a butterfly as a hedge, as an alternative. So there are all sorts of different ways to approach this. But the key, actually, I think, is the fact that right now we are at multi-month lows of volatility right along the bottom of the range. And so it is actually a particularly interesting time. It's not that volatility is super cheap or there isn't Vega risk, but it is, at least from a volatility perspective, some of the cheapest conditions we've seen in many months. And that at least is an interesting consideration that as we get further in this, it becomes more and more interesting to actually hedge that way. Actually, we might as well just comment on that, because on page 4, I do have that VIX chart. You can see that reapproaching those April and August lows pretty much right near the bottom of the 2022 range on the VIX. What's your thinking here on the VIX?
Yeah, so we've seen a lot of calm in the VIX the last few weeks, which is pretty surprising, right? We're pushing down near support at 20. As we've seen over the past year or so, when we've hit these lower levels back in late August, early September, and then also in April, we've bounced off pretty fast and those have coincided with declines in the overall broad markets, right? So remember that when the VIX is at 20, the average daily move on SPX should be about 1.25% or so, right? So we're not seeing a lot of volatility on the downside anymore. We're seeing gradual ticks to the upside. Yesterday being obviously a little bit anomalous because Powell spoke. But that being said, even on days of decline, we've seen the VIX go down as well, which is very, very strange.
Yeah.
So,
well, what's interesting about that, Nick, though, is that we actually have some interesting things coming out. Everything from in the next 3 weeks, we obviously will have a jobs numbers coming out tomorrow. We have basically an inflation number coming in the middle of the month, as well as the next rate announcement from the FOMC. And so there's room over the next 2-3 weeks to actually at least have news headlines that could drive big, at least swings in the market on a short-term basis. And volatility is not really picked up in that. So it'll be really interesting to see whether that develops new opportunities. But Nick, just circling back to page 3, we had that chart on the NASDAQ. And this time I put on the chart on the QQQ because I know that's where you analyze the levels a little bit more. What are the implied ranges on the NASDAQ?
Yeah, so looking at the NASDAQ right now on QQQ, expected moves for December 16th OPEX is plus or minus 14 points. So upside projected is 308, which is near the gap fill at 310 or so. And just to note as well, yesterday's close was the highest close we've had since the second week of September. So interesting to note that as well. Now for the downside projected, we have 280 area, which is heavy support. So remember that tech usually runs or drops harder than the broad market overall, right? So, the S&P will drop, for example, 1%, and the NASDAQ might drop 1.5% because obviously a lot more volatile names are in the NASDAQ as well. So I'm thinking, again, as I said before on the S&P, I think we see some upside in the short term on NASDAQ, especially because we've broken the recent short-term highs, right? Upside to 310 or so would not surprise me whatsoever. But again, the bear market is probably not over, so I'd be very cautious as we reach those levels. Now, we've already gone over the VIX, so moving on to page 5 on the dollar. Eric, what's changed in your thinking here?
Well, the move down on the Dixie transitioned into a sideways consolidation between 105.5 and 107.5 about 2 weeks ago. Now we're testing the bottom of that consolidation range. I'm watching for a daily close below the November 15th bottom. Absent that, we're in a sideways consolidation. I have no fundamental view on what happens next. I'm just watching the chart and waiting for it to tell me which way the market wants to go from here.
You know, it's interesting the way this consolidation's been happening, Eric. Like the dollar just obviously has been just correcting after having an extraordinary bull run through the entire since the start of the year. As you know, when I was having a conversation earlier with Nick, we were pointing out that it's actually even attempting to break down below the 200-day moving average on this on the dollar. But I think you know, when David was sharing with us during his main interview that the high of the dollar is in, I asked the question, well, sure, maybe that level may actually end up in the bigger picture being a high, but often we see retesting of highs or topping formations establish themselves. And with us going into what could end up being a very difficult 2023 year, us seeing a period where the dollar can have another leg higher, at least to at minimum retest the highs, is something I don't want to take off the table. And so while certainly it's been a bit of a correction and we're testing key levels, I still want to kind of keep a close eye to see whether or not that US dollar can start another bull run going forward.
Now on page 6, we have a chart of gold. Eric, what are you thinking on this breakout?
The last time we talked gold 2 weeks ago, I said to watch for a retest of the 100-day moving average at 1720, and I said that was the place to add to longs. That worked out perfectly, almost to the tick, and I added to my longs right there. But let's not lose sight of how we got here. To my thinking, the whole $175 rally to new highs, or at least recent highs, I should say, was brought on by the November inflation miss. Let's not forget that CPI is a famously noisy series. And despite Rosie's conviction in the feature interview that inflation has already peaked, I don't rule out the possibility of a higher print when this month's CPI comes out on December 13th. If that happens, you could see this rally reverse as quickly as it started. On the other hand, another below consensus print on December 13th could rocket the market even higher. So let's wait to see what December 13th brings before we finalize any view that a new bull market has begun. But so far, all the signs are looking pretty good.
Well, you know, one of the things I'm thinking here, Eric, is that that gold with this breakout, it's following the playbook in terms of U.S. dollar weakness, general risk on in the broader markets, and gold has actually been behaving far more like these cross currencies than they are into some of the commodities which are struggling. This currently, in my mind, has upside targets towards 1900. Whether we actually achieve 1900 is, I'm not a super certain of at least on this impulse, but move to 1850, 1875, where the highs of May and August were, I think is a very reasonable short-term target. What certainly is happening is after the gold market just being bled out, lower highs, lower lows, just systematic distribution for almost 9 straight months. Finally, the tension is back here, and it's at a time when crypto is not really working. And so it'll be really interesting to see whether or not gold will continue to build on this as we move forward, or whether or not there will be risks in the new year.
Okay, well, finally on pages 7 and 8, we have charts of the junk bonds. Patrick, what are you watching over here?
Well, to me, this is a really interesting area. Like, we keep talking about the 10-year Treasury yields, and obviously, if David is right and disinflationary pressures do emerge, maybe bonds have bottomed, and maybe we do have a chance that there could be a rally. I mean, those are things that we're going to continue to watch closely in the coming weeks and months. But the interesting thing for me is that if the bonds do rally, but the recession becomes a real risk, then we should see it start to reflect in finally credit spreads widening. So on page 8, I have the actual high yield credit spreads on junk. And with high interest rates and usually shorter durations, inevitably these junk bond companies, these high yield companies will have to be either refinancing at higher interest rates and ultimately come under duress, which could increase default rates and certainly the premiums that are being commanded in this space. Now, up throughout this first 2022 part of this bear market, credit spreads have not been blowing out. While we have seen a widening to 6%, those are not the kind of blowouts that we see typically when corporate credit gets under stress. It usually approaches 9-10%. And so therefore, the canary in the coal mine for me going into the new year is if and when these credit spreads and subsequently junk bonds start to diverge from the main bond market and start to really show that something underpinning is actually happening. Because if we start seeing junk bonds and corporate credit under stress, almost certainly it has a very good chance of causing stress in the stock markets. And that could be really where, again, like the canary in the coal mine could end up being for a turn in equities. And so that's certainly something to keep an eye on.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit macrovoices.com.